Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Jay Hatfield, founder and CEO of Infrastructure Capital Advisors. We're talking about the banking crisis and what it means for investors, particularly ETF investors. Jay, welcome to the podcast.
Nina, thanks for having me on.
So you are joining us for the first time on this show. So please tell us a little bit about yourself and Infrastructure Capital Advisors.
Yes, so my background is I have a degree in economics from University of California, an MBA from Wharton in Philadelphia, and then I've worked on Wall Street for 35 years. About half that time as an investment banker at Morgan Stanley doing utilities and MLPs and pipelines and energy. And the rest on the buy side, most notably at Steve Cohen's SAC Capital, running $1 billion for him. And now I have my own business, and we've launched, 3 active ETFs, since I started the company about 14 years ago.
Excellent. So now let's talk about the banking crisis. And the situation appears to be stabilizing over the past few days. It seems that a full-blown financial meltdown has been avoided, and that's thanks to these aggressive actions taken by the regulators. But it seems that we'll continue to see these one-off instances. For example, Western Alliance is down today after this regional bank updated its financial disclosure and didn't say anything about the deposit balance. So, do you think the banking crisis is over, or will continue to see these bank runs?
I think that it's been stemmed, but not eliminated. And particularly the risk is similar to during the financial crisis, where short sellers will pick on certain institutions, spread rumors, can also manipulate their CDS, which is the insurance against their bonds. That happened to CS First Boston or Credit Suisse. So you can, and particularly with Twitter, I think it's either illegal or should be illegal, but you can spread rumors, you can put out analysis about how this bank's weak, and that might lead to deposit outflows. And unfortunately, the Fed's misguided monetary policy means any outflows really hit you for almost 5%. So if you're paying near zero for a demand deposit and then you borrow money from the Fed, you pay close to 5. So 5% times outflows is a lot of money. So I think during earnings season, you're going to see winners and losers. So larger banks will be mostly the winners. There'll be a lot of smaller banks that are fine, but there'll be some that did have significant outflows, and therefore their earnings are going to drop. So stable, but not over.
So Jamie Dimon, JP Morgan CEO, yesterday said that the banking crisis is not over and it will cause repercussions for years to come. So let's talk about some repercussions, both short-term and long-term. And as you mentioned, that there would be winners and losers, and even among smaller banks, there are probably many banks that have these huge mark-to-market losses in their held-to-maturity portfolio. And in general, we have seen that investors have been pulling money out of these small and mid-sized banks and putting money into bigger banks, and a lot of money has flown into money market funds as well. But we know that these small and mid-sized banks are essential for the economy, particularly smaller business. They cater to smaller businesses, and if those smaller businesses find their access to bank credit restricted, that would hurt the economy, and that would ultimately cause an economic contraction. So tell us about your thoughts on the repercussions on the economy from this banking crisis?
Well, I think that there's both a big minus, which you did a good job of outlining, which is the potential for restriction in credit. But it is true that the larger banks are doing better. So in theory, they could make up for it. But it's clearly a risk. But the benefit is it really forces the Fed to wake up. We think the Fed is structurally flawed in that they have very little ability to process real-time information and really no ability to forecast either inflation or the economy. So I think it'll force them to pause at their next meeting, hopefully, worst case, raise once and then indicate they're going to pause. So that's a big positive because they were threatening to raise rates to 6%, which would have been ridiculous. So I think those two factors somewhat offset each other. And so we just anticipate continued slowing in the economy, but not a deep recession.
So you are expecting the Fed to pause interest rates now. Do you expect any rate cuts? Because the market appears to be pricing in 3 rate cuts this year. And on the other hand, these Fed officials, they keep on telling us that the Fed will continue to raise rates. Loretta Mester said today that the central bank needs to raise rates a little bit higher and then also hold them there for some time. And we know that Bullard also said something similar. So what are your thoughts on Fed rate cuts this year?
Well, I'm hopeful. It's more hoping than predicting because I have very low just like the rest of Wall Street, have low confidence in this Fed. But they really should have cut last meeting, so it's ridiculous to raise last meeting and this meeting. But to your point, I don't really anticipate them cutting for the same reason. Their forecasting model is fundamentally flawed. They learned all the wrong lessons from the 70s. They focus on really the Phillips curve, which is employment as being the key driver of inflation, and the data just doesn't support that. What drives inflation is high housing prices caused by loose monetary policy and energy and commodity shocks. And those are the key drivers here. Both of those are reversing. Inflation is dropping rapidly. But I'm hopeful that we'll have a little bit of a slowdown in the labor market. We had weak JOLTS yesterday, a weak ADP today. We're anticipating slightly weak labor report on Friday. So that should force even this Fed, which is arguably incompetent, to pause. That'll be positive, but they're going to be, again, the last to know. So it'll take them a long time to cut. But we don't see huge weakness in the economy such that it's really dependent on them cutting. We have a shortage of housing and autos. That's normally the sector that implodes. So we think that we don't really need the Fed to cut to keep the economy on track.
So the economy is clearly slowing down, and that is suggested by recent multiple data points, in fact, including the ICAP report today and ADP report as well. But do you think we will be able to avoid a recession? Do you expect a recession this year, or do you think that the Fed would still be able to somehow engineer a soft landing?
Well, I wouldn't give them any credit for engineering the soft landing, but I think we will have a soft landing simply because, and this is really one reason why they're way behind the curve, is that they're laser focused on the labor market. And the labor market is extremely resilient, partly because of the pandemic. So there's tremendous post-pandemic tailwinds, which obviously we've never had in financial history. So modern financial history. So there's two key dynamics. First of all, we have a lot of service workers who still are being employed. Even anecdotally, I think people will all agree that still see shortage in the service area. So that's offsetting layoffs in tech. But most importantly, we don't have the overhang of housing inventory. Think back to 07, 08. We had 4.5 million homes for sale. And right now we have 1.3 million, which is an all-time low. So mass layoffs are extremely unlikely in the housing sector. In fact, the housing sector is likely to stabilize because long rates, in effect, there is a rate cut going on. It's just not the Fed rate cut. The market is giving a rate cut to the cyclical industries like autos and housing. As the 10-year drops, those financing rates will drop. So because of the market rate cut, we think we'll have slow growth, not even a technical recession, but that's up to the NBER to really judge that. We don't think really to have a recession, you have to have significant increase in unemployment. We don't see that. So we're more optimistic than most about the resilience of the U.S. economy.
Okay, great. So I wanted to go back to one of your comments about this crisis, and you said that risk is similar to the great financial crisis, but it seems that you, like many other experts, also believe that this may not be a repeat of the 2008 crisis. Could you talk a little bit about that?
So this financial crisis, or banking crisis really, because not financial, all financials, is less severe because it's not related to credit like it was during the mortgage crisis. So it's mostly just duration risk. All banks have some duration risk. The Fed raised rates too quickly. They have the ability to reduce that, to mitigate the problem, but the market is really bailing out at least companies that have longer term investments like in mortgages. Mortgages are rallying as the 10-year drops. So that's mitigating the problem, which wouldn't happen. If it was a credit problem, that wouldn't benefit the banks. So many banks are actually going to report way less mark to market and pretty strong earnings. It's only going to be a few banks that lost deposits and bigger banks gained deposits. So it's completely different than the financial crisis. First of all, it's pretty much focused on just banking, not insurance and other sectors, number one. And then number two, there's a lot of winners and a few losers. So that was definitely not the case during the financial crisis.
So let's talk about what this crisis means for investors now, particularly investors in bank stocks or ETFs. Let's start with those who are invested in common stock. So the regional banking ETF is now down about 27% year to date. It was in fact one of the worst performing ETFs of the first quarter. And even the Invesco KBW Bank ETFs, which has a lot of exposure to bigger banks, which you mentioned that they may in fact emerge as winners in this crisis, that is also down about 21% because investors have dumped all banks and all bank ETFs. So do you see an opportunity here for regional banks or for bigger banks?
Well, our theory is when you have a crisis or sort of an explosion, don't go right into the middle of the blast zone, but go to areas that really weren't directly affected, but yet did trade down. So the ones that are obvious, larger banks, even super regional banks, we think will benefit. We won't know for sure until they report, but we suspect they're benefiting, getting deposit inflows. The money center banks should also be getting inflows, but also an easier trade is really to buy insurance companies because they don't have deposits. So they can't, by definition, can't lose them. They did have some issues with mark to market. They tend to invest in longer term bonds. So when they report, their balance sheets are going to look way better because they're going to have less mark to market loss. So we think it's better to not go right into the blast zone and pick smaller regional banks, but either larger banks or even better insurance companies.
Now let's talk about preferred issued by these banks and other banks too. So the preferreds issued by SVB and Signature Bank that I understand will have either little or no recovery value. But in general, preferred stocks have been quite popular with income-focused investors, mainly because of the juicy yields that they offer and also relative safety. So I was interested in your thoughts on preferred stocks and ETFs issued that are focused on banks. And before that, let's take a step back and also talk about what exactly are preferred stocks? Because I don't think many of our listeners understand properly. So tell us, what are preferred stocks, and then your thoughts on preferred stocks and ETFs.
So the preferred stocks that we focus on, and we'd recommend that your listeners focus on as well, are what called $25 preferreds. So they're listed, liquid, traded normally on the New York Stock Exchange. They're callable at par, which is $25, but as you pointed out, they have attractive yields, and they're almost all the securities are issued also by public companies. So these are companies that care about their credit. So we think it's an attractive asset class, but we do think that active management is critical because it's important to have an active manager avoid big losses. Because the problem with preferreds, what's great about them, they're senior to common, that gives them safety, but they don't do well in a bankruptcy. So like the preferreds of Signature and Silicon Valley both got de facto wiped out or will get wiped out. So you want to avoid the bad credits. Fortunately, there haven't been a lot of bad credits. The default rate's only about 0.3% per year in $25 preferreds. But nevertheless, selection can keep you out of those kind of issues. And so we also we have a very small allocation to financials. A lot of them are insurance companies or larger banks and not regional banks. What we prefer hard asset companies. We think that's better collateral. They have lower leverage than financials. So companies that are in the utility sector, pipeline sector, industrials, REITs are actually good credits, not buildings, but REITs are actually good credits. So because of the collateral, they have a lot of unlevered real estate. So we do a lot of credit analysis and look at the asset value of what we're investing in. And that's always difficult with financials because they're 9-to-1 or higher levered.
So you manage 3 ETFs. These are actively managed ETFs. Tell us about these ETFs.
So we touched on the preferred. That's PFFA is our active preferred fund. The yield is attractive right now, over 10%. So it's a good trade to buy preferreds when the market's down because you get equity upside if they trade back to par, but you get good yields while you buy them. Our fund roughly trades where all the underliers trade in the 19 range. So you have like $5 or $6 of upside. So we think that's a good, attractive way to get into this market and not take as much risk as you would with common stocks because the volatility of preferreds are usually about half the market. And then we have 2 other funds that are also dividend funds. All these funds pay monthly. ICAP is a large cap dividend fund, mostly household names. We write covered calls only on stocks where we have gains, which we think is a better strategy. That has an attractive yield well over 7, and also defensive companies. And then AMZA is a pipeline fund. So we own pipeline structures, MLPs. We're corporations, so you don't get a K1. And attractive dividend yields well above 8%. And is attractive sector where there's continued slow growth in energy infrastructure in North America.
Great. So we have seen that investors have been putting a lot of money into these tech giants lately. And also we have seen massive inflows into money market funds, which I mentioned earlier as well. So do you like any areas of the market in addition to the ones that we talked about, big banks, insurance, and preferreds, non-financial preferreds? Which other areas should investors be putting their money to work now?
Well, it makes some sense, although arguably tech has kind of gotten ahead of itself a little bit. But we think later in the year, tech will continue to do well because of enthusiasm, even maybe potential over-enthusiasm about AI. So tech, we are positive on this year. We think it may not be the second in time, but REITs, or in our models, show REITs to be very, very undervalued. Again, as I mentioned, they're not like buildings. They're not 70% levered. They're 40% levered. The public markets tend to overreact. Yes, there's some weakness in certain sectors, but real estate has long-term fundamental value. So we think REITs are also attractive. In the short run, owning utilities might be the right answer because of this fear about the potential recession, although they're going back towards a higher valuation right now, so maybe a little bit more neutral.
Excellent stuff. That's all we have time for today. Jay, thank you for joining us.
Thank you, Nina. It was great being on.
So that was Jay Hetfield. Let's quickly recap ETFs that we discussed and some more. So we talked about the InfraCap's preferred stock ETF. The ticker symbol is PFFA. And as Jay mentioned, this generally avoids banks. So if you invest in preferred stocks because of their juicy yields, or if you see relative safety, you should remember that in general, preferred stock ETFs have a lot of exposure to banks because these preferred stocks are generally issued by banks. For example, the most popular preferred stock ETF, it is by iShares. It is the iShares Preferred and Income Securities ETF. The ticker symbol is PFF. And if you look at its portfolio, it has about 68% exposure to financial institutions. If you want to totally avoid exposure to banks and financial institutions because you are not comfortable with this recent crisis and its impact on preferred stock, so VENEC offers a preferred stock ETF, which is X financials. It totally avoids financials. PFXF is the ticker. Now, going back to InfraCap ETFs, we also talked about the equity income ETF. The ticker symbol is ICAP. This is also actively managed. And another actively managed ETF that we talked about is the MLP ETF. The ticker symbol there is AMZA. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe to our podcast so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.